Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about DIGITALBRIDGE Group INC quarterly report. DigitalBridge is a leading global alternative asset manager that provides various services to invest in digital infrastructure. The company's portfolio includes cell towers, data centers, fiber, small cells, edge infrastructure. These investments are managed by the DigitalBridge team, who oversee $106 billion worth of infrastructure assets on behalf of their clients and shareholders. The stock price of DigitalBridge Group Inc. (DBRG) has dropped by over -5.52% in the past year due to several significant events. The company's shares fell 6.1% on October 29, 2025, following disappointing earnings from major technology companies and new trade tensions. Additionally, DigitalBridge missed market revenue expectations for Q3 2025, with a substantial 95% year-over-year decline in revenue. Furthermore, the company lowered its 2024 guidance for fee revenue and fee-related earnings on November 1, 2024, causing a 17% drop in shares. These events collectively contributed to the stock's price decrease of 21.86% over the last 12 months as of October 31, 2025. The primary drivers of revenue growth or decline for a financial institution can be attributed to several key factors. Fee revenue is a significant contributor, with a 22% increase due to capital raised for new funds and co-investment vehicles. However, it also experienced a 1% decline compared to the same period last year. Carried interest allocation had a substantial impact on revenue, decreasing by $104.4 million in Q3 2025 and -$557.1 million in YTD 2025 due to unrealized carried interest reversals. Principal investment income saw an increase of $15,370 for 3 months and $22,287 for 9 months. Incentive fees also experienced growth, increasing by 64.4% for the 9 months ended September 30, 2025 from sub-advisory accounts in liquid securities strategy. These factors collectively drive revenue growth or decline, with fee revenue and carried interest allocation being the most significant contributors. Net income and profit margins. A shift in fortune. The financial summary reveals a significant change in net income and profit margins between YTD 2024 and YTD 2025. Initially, net income decreased from $147,494,000 to -$53,343,000, indicating a substantial decline. However, this trend reversed in Q3 2025, where net income increased to $16,753,000. Profit margins also underwent a notable change, with the net income margin decreasing from 2.74% to -0.18%. Conversely, distributable earnings increased by $11 million to $21.7 million, suggesting an improvement in profit margins. The reasons behind these changes are inferred but not explicitly stated. It is likely that changes in business operations or investments contributed to the decrease in net income. Additionally, increased expenses related to private aircraft and investment in managed investment vehicles may have played a role. The unrealized gain/loss from changes in fair value of underlying fund investments also drove changes in principal investment income. Overall, the shift in net income and profit margins highlights the complexities of financial performance and the need for careful analysis to understand the underlying factors driving these changes. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the financial summary, the company has consistently produced positive operating cash flow in both years. Specifically, on page 24 and page 49, it is stated that the net cash provided by operating activities for September 30, 2025 was $411,403,000. This demonstrates a healthy financial position, allowing the company to invest in its business, pay off debts, or return value to shareholders. The company's debt level has experienced significant changes over the past year. Initially, it increased from $296,362 in December 2024 to $327,945 in September 2025, a rise of $31,583. Furthermore, the debt obligation grew by $8.8 million between December 2024 and September 2025, Additionally, there was an increase from $0 to $29,547 in September 2025. In terms of interest expenses, the company has seen a notable increase. The interest expenses rose by plus 14% 3 months and plus 6% 9 months compared to 2024. This trend is consistent across multiple pages, with increases ranging from plus 14.6% to plus 6.1%. Specifically, there was an increase of $0.6 million in quarterly interest expenses and $0.7 million in yearly interest expenses. Additionally, the annual interest expense rose by $78,000 from 2024 to 2025. Overall, both debt level and interest expenses have increased significantly over the past year, indicating a substantial change in the company's financial situation. Management is shifting the company's focus towards digital infrastructure, transforming it into an investment manager with a digital infrastructure focus. The company is disposing of residual activities from former real estate investments to concentrate on its core business. To achieve this, management has expanded the company's investment offerings to include core equity, credit, and liquid securities. The company expects to continue growing its fee-earning equity under management, FEUM, through strategic capital raising efforts, with $4.1 billion raised in the third quarter of 2025. This growth is expected to drive a 22% increase in fee revenue to $93.3 million in the quarter-to-date comparison. Management believes that the company has sufficient liquidity to meet its short-term and long-term needs, allowing it to focus on strengthening its liquidity and providing operational and strategic flexibility. Overall, management's strategy aims to capitalize on opportunities in digital infrastructure while maintaining a strong financial position. The company has made several strategic moves through acquisitions and divestitures. Key acquisitions include the former real estate investments and adjacent investment management business on page 28 and InfraBridge in February 2023. On the other hand, the company has divested residual activities from former real estate investments and adjacent investment management business, 3 warrants sold to a third party, and redeemed membership units, OP units, for shares of Class A common stock. The company has a history of paying dividends to its shareholders. Specifically, it declared and paid out $0 and 1 cent per common share in both 2024 and 2025. This indicates that the company prioritizes returning value to its investors through dividend payments. And concerns about inventory buildup and supply chain disruption exist. The company's financial summary highlights 2 key concerns that could impact its operations. Firstly, there are ongoing payments to affiliates, warehoused investments, and Vantage SDC for expansion capacity, totaling $14.8 million in 2025. This suggests a potential buildup of inventory due to these commitments. Furthermore, the company has invested $37.9 million in warehoused products for potential new offerings in 2025. While this investment may be strategic, it also increases the risk of supply chain disruption if demand does not materialize as expected. These concerns underscore the need for careful management and planning to mitigate these risks and ensure a smooth supply chain operation. That concludes the financial summary for DIGITALBRIDGE Group INC. Feel free to comment below, and I will be happy to answer them when possible.